Okay, students, let's start the discussion of test on IAS 12. Okay. Which of the following is incorrect? Normally, you will find in exam that which one is correct, but right now examiner is asking us which of the following is incorrect. We have to find out which option is incorrect. Okay. A piece of machinery costing 5 lakh. Tax depreciation to date has been amounted to, let's say, rupees 2,20,000. That is tax depreciation. And depreciation charge in the financial statement date is 1 lakh. Tax depreciation is 2,20,000 and accounting depreciation is 1 lakh. The rate of income tax is 30%. Repeat. Tax depreciation is 2,20,000. Accounting depreciation is 1 lakh. So let me just show you. We normally prepare 3 columns: tax base or carrying amount, tax base, temporary difference. Actually, we prepare 3 columns. One is carrying amount, another is tax base. Tax base means the value of your asset or liability according to the taxation authorities. Okay. We have discussed many times that tax base for a depreciable asset is tax written down value. So we have a machine. Now look at this. Cost is 5 lakh. Accounting depreciation is 100,000. It means the carrying amount is 400,000. Tax base for a depreciable asset, tax base for the depreciable asset is tax written down value. Cost is 500,000. Tax depreciation is 220. It means tax base is 2,80,000. So in case of assets, we know that when carrying amount is more than the tax base, then difference is the taxable temporary difference. 120 is a taxable difference. Taxable difference multiplied by tax rate gives us deferred tax liability. Deferred tax liability. In case of assets, we have discussed these relationship many times in our regular classes. Whenever in case of assets, carrying amount is more than the tax base, difference is the taxable temporary difference. Taxable temporary difference multiplied by tax rate gives us deferred tax liability. Okay, now come here. Which of the following is incorrect? Which of the following is incorrect? The deferred tax liability to the asset is 36,000. That is correct. We need to find out which one is incorrect. Tax base of the asset is 280. Yes, it is 280. There is a taxable temporary difference of 120. Yes, taxable. So incorrect is C. C says is a deductible temporary difference. No. In case of assets, when carrying amount is more than tax base, difference is a taxable temporary difference. In question 1, we are required to find out incorrect option. So C is the incorrect option. Let's go for second one. What is the income tax expense that will be shown in the statement of profit and loss? Okay. Tall Limited accounting records. Income tax payable for the year. Current tax payable is 60,000. Over provision in relation to the previous is 4,500. Listen carefully. Over provision of income tax actually reduces current year income tax expense. Under provision increases current year income tax expense. Repeat, over provision of tax decreases your income tax expense without having any impact on your current tax payable. Opening deferred tax liability is 2,600 and the closing deferred tax liability is 3,200. So it can be seen that there is an increase in the deferred tax liability. Increase in deferred tax liability will increase your income tax expense. Repeat. Increase in your deferred tax liability will increase your income tax expense. Please look at this. Question number 2. Closing deferred tax liability is 3,200. Opening deferred tax liability is 2,600. So there's an increase in the deferred tax liability 600, which is your deferred tax expense. Deferred tax expense. So simply we'll take income tax payable, which is 60,000 minus over provision. Let me repeat, over provision of taxation reduces your current year income tax expense without having any impact on the current year tax payable. Simply add your deferred tax expense 600. So let me use the calculator. 60,000 minus 4,500 plus 600. I'm getting 56,100. So income tax expense is 56,100. We have ignored 3 zeros. So the option is delta. The same thing can be solved by using T account. Taxation T account. Brought down. Current tax plus deferred tax. Carried down. Current tax plus deferred tax. Okay. There's a possibility, and we have studied also. Deferred tax can arise due to revaluation surplus. If deferred tax arises from revaluation surplus, then it is charged to revaluation. In that case, you will debit OCI, other comprehensive income. OCI. Repeat. If the revaluation arises, if deferred tax liability arises from revaluation surplus, then it is charged to revaluation. The double entry is simply revaluation slash OCI debit and deferred tax liability credit. Okay. Now, here the balancing figure comes that goes to income. This balancing figure is your income tax expense. And that income tax expense goes to profit and loss. If the balancing figure comes on debit side, then that balancing figure shows tax paid. So if the balancing figure is coming on the credit side of your T account, it is income tax expense. If the balancing figure in your T account is coming on the debit side, it represents tax paid. Now let's apply this T account on this question, which is given to us. Question number 2. Taxation. Brought down. Over provision of income tax comes on credit side. So current tax 4,500. Opening liability of deferred tax is 2,600. CD. Closing liability of current tax is 60,000. Closing liability of deferred tax is 3,200. So here comes the balancing figure that goes to P&L. It is your income tax expense. This will be 63,200. Obviously, it has to be 63,200. From 63,200, let us deduct 4,500 minus 2,600. So the balancing figure is 56,100. So you can solve by the help of T account or otherwise through statement form. Okay, this question we did it previously as well. The following information has been extracted from the accounting records of Kendall Limited. Estimated income tax relating to 2020 is 75,000. Income tax paid, actual payment is 80. It means there is an under provision of 5,000. If previous year income tax is less, but actual payment is more, then it is representing under provision. Under provision increases your current year income tax expense without having any impact on your current year liability. Estimated income tax for the year is 2021. it will increase by 5,000, which is under provision. What figure will be shown in the statement of comprehensive income? It will be 88. So always remember one point, under a provision increases your current year income tax expense. Okay, now come here. Home Limited has the following balances included on its trial balance. Basically at 2013, just a typing error. So these are the opening balances. Taxation balance related to an over provision. So simply, if taxation balance comes on credit side, it is over provision. If it comes on debit side, then it is under provision. At 30th June 2014, current year end, the director estimated the provision necessary for taxation on the current year profit is 15 million. This 15 million is your current tax payable. The carrying amount of net asset, non-current assets exceeds the tax written down value by 30 million. Carrying amount of non-current assets. We have discussed the relationship many times. In case of assets, whenever carrying amount is more than tax base, whenever carrying amount is more than tax base, then difference is the taxable difference. And taxable difference multiplied by tax rate gives you deferred tax liability. In case of assets, when carrying amount is more than the tax base, difference is the taxable temporary difference, and taxable temporary difference multiplied by tax rate gives us deferred tax liability. Okay. So they have given you taxable difference of 30 million. What is the charge for taxation that will appear in the statement of profit and loss? Fine. We need to just find out income tax expense. Let me first calculate the closing deferred tax liability for you. Closing deferred tax liability. We are ignoring 3 zeros. So 30,000 multiplied by 30%. Closing deferred tax liability S9. Let me check the tax rate. Yes. Closing deferred tax liability is 9,000 less the opening liability. Opening deferred tax liability is 12,000. So this time liability is not increased, it has actually decreased. A reduction in deferred tax liability. A reduction is deferred tax liability is your deferred tax income. It is logically your deferred tax income. And deferred tax income decreases your income tax expense. Deferred tax income decreases your income tax expense. Okay. And this 4,000 taxation is your credit balance is representing the over provision. And what over provision does, actually over provision reduces your current year income tax expense. Current year tax payable is 15,000. Now look at this. Current tax payable is 15,000 less the over provision. Over provision they have given us 4,000 less deferred tax income, less deferred tax income. I'm getting income tax expense 8,000, or by putting 3 zeros, 8 million. Income tax expense. Now let's try to solve question number 3 or question number 4 by using T account. Question number 4 by using T account. Taxation brought down. Opening balance of the current tax is 4,000 and deferred tax is 12. Closing balance of the current tax is 15 million. And closing balance of the deferred tax is 9 million. We have calculated this. It is 24,000. So here it has to be 24. Balancing figure is income tax expense. Income. Obviously from 24,000, when I'm going to deduct 16, 4 plus 12 is 16. Then balancing figure income tax expense is 8,000. Let's deal with question number 5 again, please. These are the opening balances. The taxation relate to an over provision from 30th June 2015. So Hall Limited has the following balances on the trial balance on 30th June. And these are basically over provisions. Okay. At 30th June 2014, the directors estimate that provision necessary for taxation on the current year, or let's say you can do this. Examiner has clarified here the taxation balance relate to an over provision from the 2013. So in the trial balance to 2014, they have given you the simply opening balances of taxation and deferred tax liability. At 30th June 14, the director estimated what we need to calculate. What is the charge for the taxation will appear in the statement of P&L. Question number 5. Again, let's go for the T account. That will help you. $7,000 plus $16,000. At 30 June 14, director estimate that provision necessary for taxation on current year profit is 12 million. Current tax carried down is 12 million. The balance on the deferred tax account needs to be increased to 23 million. So if I add both of them, 12,000 plus 23,000, I'm getting 35,000. Okay. What else? The balance on the deferred tax account needs to increase to 23 million, which includes the impact of increase in the property valuation. During their Hall Limited revalued its property for the first time, resulting in a gain of 10 million, and the rate of tax is 30%. Now listen carefully. When deferred tax liability arises from revaluation surplus, then it is charged to revaluation. So basically, this 23 million includes the impact of revaluation deferred tax liability, which relates to the revaluation surplus. So 10 million multiplied by 30%. The deferred tax liability of 3 million. If you let's work on millions. Just a minute. Let's take it millions. 7 million, 16 million, 12 million. It's the same thing, in fact. So simply, when deferred tax liability relates to the revaluation surplus, it is charged to revaluation. So OCI will be debited by revaluation surplus less OCI debited by 3. Deferred tax liability will be credited by 3. Balancing figure is your income tax expense, which goes to profit and loss. Income tax expense. Balancing figure. Let me calculate. 35 minus 3 minus 7 minus 16. I'm getting 9 million. So your income tax expense, which goes to P&L, it is 9 million. Okay. Vast Limited assistant accountant has discovered that there's a debit balance. Debit balance of taxation shows under provision in the T account. And credit balance shows over provision. Was Limited assistant accountant has discovered there is a debit balance in the trial balance of rupees 3,000 relating to the over under provision. Debit balance is under provision, and I'll repeat. Under provision increases your current year income tax expense. Your current year income tax expense without having any impact on your current year liability. Repeat. Under provision increases your income tax expense without having any impact on current year liability. So what impact will have this on the current year financial statement? Income tax liability will increase by 3. No. Tax liability decrease? No. Increases tax expense by 3,000 in the statement of profit and loss? Yes. So simply debit balance shows under provision increases your income tax expense without having any impact on your current year tax liability. What amount will be shown in the statement of profit and loss? So let's go for T account of taxation. A company's trial balance shows a debit balance under provision 2.1 million. Brought forward on current tax and credit balance 5.4 million. Deferred tax. The tax charge for the current year is estimated to be 16.2 million. Carrying amount of net assets 13 million in excess of their whenever assets carrying amount is more than the tax base. Whenever assets carrying amount is more than the tax base, it is a taxable difference. Taxable difference multiplied by tax rate gives us deferred tax liability, which is 3.9. So the closing deferred tax liability is 3.9. Balancing figure, let's try to find out. That goes to P&L. 2.1 plus 16.2 plus 3.9. I'm getting 22.2. It has to be here 22.2. Minus 5.4. 16.8. This is your income tax expense which goes to P&L. Income tax expense, and that goes to P&L. What is the profit and loss tax charge for the year ended 31st December 2013? Students, please try to attempt the question number 8. Then we'll be solving it together as well. Now, just try to make the T account, please. And one more thing we have already discussed. If the deferred tax liability arises from revaluation surplus, then it is charged to revaluation. Okay, student, let's see. Answer. Okay. Question number 8. Just prepare the taxation T account. A company's trial balance on December 2013 shows a debit balance means under provision 0.7 million. Credit balance deferred tax 8.4 million. The director have estimated provision for income tax for the year is 4.5. And required deferred tax provision 5.6, comma rupees 1.2 million, which relates to property revaluation. Let's see the balancing figure that goes to income. P&L, that is your income tax expense. 0.7 plus 4.5 plus 5.6. 10.8 minus 1.2 minus 8.4. 1.2 is the correct answer. And one of the students has given the correct answer. Okay. Now, question number 9. What is the deferred tax liability required by IAS 12 income tax? So simply December 2018, we just need to find out closing deferred tax liability. Okay. The following information relates to an entity. At 1st January 2018, let me show you. Question number 9. Carrying amount, tax base, temporary difference. At 1st January 18, the carrying amount of non-current asset exceeded their tax return on value by 850. Carrying amount of non-current assets is more than the tax base. So this 8,50,000, can I say this 850 is a taxable temporary difference? Read it again. January 18, the carrying amount of non-current assets exceeded their tax base. So when carrying amount is more than the tax base, so difference is the taxable temporary difference. For the year ended December 18, the entity claimed depreciation for tax purposes 5 lakh and charged depreciation 450 in the financial statement. That is very important. Point number 2. For the year ended December 18, entity claimed a depreciation for tax purposes 50,000. Now listen carefully. Whenever tax depreciation is more than accounting depreciation, whenever tax depreciation is more than accounting depreciation, the difference will be a taxable temporary difference. How? Let me explain. For example, assuming plant and machinery is having a cost of 1,000. Accounting depreciation is 450. It means the carrying amount is 550. Assuming plant and machinery is having cost 1,000, tax depreciation they have given us 500. So logically the tax base is 500, carrying amount is 550. So it can be seen when accounting depreciation is less than tax depreciation. Whenever accounting depreciation is less than tax depreciation, the difference is the taxable temporary difference. You can see also, I just assume that plant and machinery's cost is 1,000, accounting depreciation is 450. So from plant and machinery costs, I've deducted accounting depreciation. So I got a carrying amount of 550. Cost 1,000, tax depreciation 500. So tax base is 500. You can see that assets carrying amount is more than the tax base. When assets carrying amount is more than the tax base, then difference is the taxable temporary difference. So always remember one point. When accounting depreciation is less than tax depreciation, difference is your taxable temporary difference. Or other way around, when tax depreciation is more than accounting depreciation, it's the same thing. Difference is the taxable temporary difference. And we know that taxable temporary difference multiplied by tax rate gives us deferred tax liability. So let's say due to depreciation is a 50,000 taxable temporary difference, because accounting depreciation is 450, tax depreciation is 5 lakh. Whenever tax depreciation is more than accounting depreciation, whenever tax depreciation is more than accounting depreciation, difference is the taxable temporary difference. During their ended December 18, the entity revalued a property. The revaluation surplus is 250. There are no current plans to sell the property. Very important point. Revaluation. Always remember that revaluation always results in a taxable temporary difference. Why? Because taxation authorities do not accept revaluation as your gain. Repeat. Revaluation will always result in a taxable temporary difference. So due to revaluation, there's a taxable temporary difference of 250. If I add all of them, 850, 50 plus 250, total taxable temporary difference is 11,50,000. Tax rate is 30%. Here comes the closing deferred tax liability, and examiner has asked us only show the closing deferred tax liability. 3,45,000. Let's read the question again. What is the deferred tax liability required by IAS? So what is the deferred tax liability? Deferred tax liability required is 3,45,000. So the closing deferred tax liability is 3,45,000. The accountant of an entity is confused by the term tax base. I think we did repeat many times in our earlier lectures as well. Tax base means the value assigned by tax authorities to your assets or liabilities. Simply, according to the tax authorities, what is the value of asset or what is the value of liability? The accountant of an entity is confused by the term tax base. What is meant by the tax base? The amount of tax payable in a future period, no. The tax regime under which an entity, no. The amount attributed to an asset or liability for Charlie. So Charlie is the answer. The amount attributed to an asset or liability for tax purposes. Okay. In question number 11, we have to just find out property, plant and equipment development expenditure. Let's see. What is the taxable temporary difference to be accounted for December 2014 in relation to the property, plant and equipment and development expenditure? We need to find out the taxable temporary difference, which is coming from property, plant and equipment and development expenditure. Fine. Let's try. The amount of, the carrying amount of Jules Limited's property, plant and equipment. December 2013 was 3,10,000 and tax written down value is 2,30,000. The carrying amount of Jules Limited property, plant and equipment December 13 was 310 and tax return value, okay, that is 2013. And here examiner is not asking for the 2013. Examiner is asking what is the taxable temporary difference to be accounted for 2014. Okay. The following data relates to December 2014. At the end of the year, carrying amount of the property, plant and equipment is 460. At the end of the year, that's question number 11. Carrying amount, tax base, temporary difference. December 14. Carrying amount of property, plant and equipment is 460. At the end of the year, carrying amount of property, plant and equipment is 460 and tax return on value is 270. Tax return on value is the tax base. So it means 4,60,000 minus 270. 1,90,000 is a taxable temporary difference relating to property, plant and equipment. Taxable temporary difference. At the end of the year, carrying amount of property, plant and equipment is 460 and tax return on value is 270. During the year, some items were revalued by 90,000. No items had been previously required revaluation. In the tax jurisdiction in which JL operates, revaluation assets do not affect the tax base. We know that. Or taxable profit. Gains due to revaluation are taxable. When you are going to sell, only then they are taxable. There's no need to do anything relating to this 90,000. They're not saying that we did not record the 90. They're saying during there's some items of property, plant and equipment they were revalued. So it means within this 460, 90,000 is already included. No need to do anything. JL began development of a new product during there, and capitalize means it becomes your asset 60,000. Simply intangible asset 60,000. The expenditure was deducted for tax purposes when it was incurred. So we have capitalized development expenditure 60,000. It is our intangible asset, but according to the taxation authorities, they do not accept your asset as an asset. According to the taxation authorities, this 60,000 should be expense out. Repeat. JL began development of a new product during there and capitalized 60,000. Capitalized means it becomes your asset in accordance with IAS 38. But taxation authorities, they are saying the expenditure was deducted for tax purposes when it was incurred. So according to the accounting people, 60,000 is your intangible asset, but taxation authorities, they are saying it is treated as an expense. So they're not accepting your asset as an asset. When taxation authorities do not accept your asset, it means the tax base is zero. Repeat. When taxation authorities, they do not accept your asset as an asset, then tax base is zero. We let me give you the example of this thing. We did discuss in case of IFRS 16 leases. We do record in lessee's books right of use asset, debit, lease obligation, credit. But taxation authorities do not accept right of use asset as your asset. So the tax base is zero. Over here, why tax base is zero? Because we are saying 60,000 is our intangible asset, but according to the taxation authorities, they are treating it as an expense. They're not accepting your asset as an asset. So relating to R&D, there's a taxable temporary difference of 60,000. So relating to property, plant and equipment, relating to property, plant and equipment, relating to property, plant and equipment. Taxable temporary difference is 190, relating to R&D, it is 60. Charlie. Okay, question 12. What amount should be charged to the revaluation surplus? December 14 in respect of the deferred tax. I think we did discuss many times. Let me repeat again. When deferred tax liability arises from revaluation, it is charged to revaluation. The revaluation surplus is 90. 90,000 multiplied by 30. It is 27,000. Logically, revaluation will be debited by 27 and deferred tax liability will be credited by 27. So when your deferred tax liability arises from revaluation, it is charged to revaluation. What amount will be shown in the current tax payable in the statement of financial position? Current tax payable. The current tax charge was calculated 45. So 45,000 is the answer because examiner is asking us what amount will be shown in the current tax payable. So 45,000 is your current tax payable. Deferred tax asset and liabilities arise from taxable and deductible temporary differences. Which of the following is not a circumstances giving rise to a temporary difference? Always remember one point. Whenever taxation and accounting treatment is same, then there will be no taxable difference, there will be no deductible difference. These differences will only arise when accounts and taxation treatments are different. So we need to find out when there will be no temporary difference. Depreciation accelerated for tax purposes. If you are getting more depreciation for tax purposes, less depreciation for accounting purposes, then temporary difference will arise. Development costs amortized in profit and loss, but tax was deducted in full. When incurred. So point number B, definitely taxable difference will arise. How? We have capitalized the development costs and slowly and gradually we are amortizing, but according to the taxation authority, treat entire development cost as an expense. So there's a difference between the accounts and tax treatment. accrued expenses means expense debit accrual credit, which have already been deducted for tax purposes. Due to C, there will be no taxable or deductible difference. Why? The double entry of accrued expenses is expenses debit accrual credit. So accounts people, they do treat the debit side of accrual as an expense, obviously, and taxation authority, they are saying we have already accepted that as an expense. So basically in point number C, the accounting and taxation treatment is same. So whenever accounts and taxation treatment is same, then there will be no temporary difference. So accrued expenses, according to the accounting, it is an accrued expense means expense debit accrual credit, and taxation people, they are saying we have already deducted. Okay, now D, revenue included in accounting profit when invoiced, but only liable for the tax when cash is received. D will result in a taxable temporary difference. Why? Obviously, when you are selling, they are saying revenue included in an accounting profit when invoiced. So as soon as you have given invoice to your customer, you take that into as a revenue, simply debtors debit revenue credit. But according to the taxation people, only liable for tax when cash is received. So simply you will be having the receivable in point number D, but tax base of those receivable will be zero. Why zero? Because taxation authorities do not accept receivable. They are saying we will ask you to pay the tax when you have received the cash. So when temporary difference will not arise when accounts and taxation treatment is same, and that is part C. So 14, the answer is Charlie. 15. Which of the following statements regarding taxation of lease arrangement are true? Depreciation expense and interest expense should be added back. Yes, it is true. Rental payment should be deducted from the, yes, true. A right of use asset tax base is nil, resulting in a taxable temporary difference. True. Lease liability have tax base nil, resulting. All are true. And we have discussed all these points when we were obviously studying IAS 12. All for D. All of them are correct. Okay. What will be recorded as the tax expense in the statement of profit and loss in December 2018? What will be recorded as in tax expense? Question number 16. Taxation. Vinins Limited. Assistant accountant estimate tax expense for the year ended December 2018 is 43,000. This is your closing current liability, current tax payable. However, he had ignored deferred tax. On January 18, VL had a deferred tax liability 130, deferred tax liability, opening 130. December 18, VL had temporary taxable difference 360. Multiply by 25% the tax rate. We will get closing deferred tax liability. So 360 into 25, I'm getting 90,000. Closing deferred tax liability is 90. So plus 90. So 43,000 plus 90. So income tax expense which goes to P&L is 3,000. If the data is in million, then we'll work in million. It's not in a million, thousand. It's 3,000. So simply assistant accountant estimated tax 43,000 is your current liability closing balance. And your assistant accountant ignored the deferred tax liability. Opening deferred tax liability is 130, closing is 90. Logically, there's a reduction in the deferred tax liability by 40. And reduction in deferred tax liability decreases your income tax expense, and it happened. Instead of 43, it is just 3. Question number 17. What amount of tax paid during the December 2012? Again, I would say T account will help you. Taxation T account. We have opening balances 140, 160. The tax charge in the statement of P&L is 270. That goes to P&L. Income tax expense. Let me use the calculator. 140 plus 160 plus 270. So the balancing figure is tax paid. $130. Tax paid is 130. Okay. What will be shown as income tax charge in the statement of P&L? Okay. The trial balance of Hall Limited showed credit balance. Basically, these are the opening balances of current tax and deferred tax. Let's question number 18. BD and CD. So these are the basically opening balances. There's a typing error, you can say. So when opening balance of the current tax is on credit side, it is over provision. It is 0.8 million and deferred tax is 2.6 million. 0.8 million and 2.6 million. A property was revalued during there, giving rise to a deferred tax 3.75. Deferred tax 3.75. This has been included in the deferred tax provision 6.75. So closing balance of the deferred tax is 6.75. That's a closing balance of deferred tax. The income tax charge for the year. So closing balance of current tax payable is, your current tax is 19.4. So let me 19.4 plus 6.75, I'm getting 26.15. From this 26.15 minus 0.8 minus 2.6 minus 3.75. I'm getting income tax expense 19. Okay. What is the amount of deferred tax expense or income in respect of the above for the year ended 30th June 2018? What is the amount of deferred tax expense? Obviously, if the deferred tax liability increases, then it is deferred tax expense. If the deferred tax liability reduces, then it is deferred tax income. Let's read. What is the amount of deferred tax expense or income in respect of the above for the year ended 30th June 18? Orange Limited is in the process of finalizing its financial statement for the year ended 30th June 2018. Okay. OL sells goods with a 1-year warranty. They do provide warranty, but only for 1 year. And it is estimated that warranty expense are 2% of sales. So 2% of the sale is the warranty expense. Fine. Actual payment during their related to the warranty claim were 54 million. Of these, 38 million pertain to goods sold during the previous year. So out of 54 million payment, 38 million actually relates to the previous year. Opening balance of the provision for the warranty is 49 million. Sales for the year ended 30th June 2018 was 1750. Under the tax law, these expenses are allowed on payment basis. Applicable tax rate is 30%. And we have to just show what is the amount of deferred tax expense or income. Please now try to understand. Question number 19. Taxation authorities, they do not accept any provision as your liability. If they do not accept, let's say, any provision, so they are not accepting warranty provision as your liability. If they're not accepting warranty provision as your liability, then tax base is 0. Now, please try to understand. Number 1, carrying amount, tax base, temporary difference. Examiner has given you the warranty provision, but opening balance. Examiner has given us the warranty provision, but the opening balance. For example, if we are working for 30th June 2018, so basically, let me make it easy for you. Opening balance which examiner has given us, it is 49 million. It means 30th June 2018 means 30th June 2013, the previous year. Carrying amount, tax base, temporary difference. Warranty provision for the previous year is 49, tax base is 0. So there's a 49 deductible temporary difference, deductible. Whenever liability is having a carrying amount more than the tax base, so it results in a deductible temporary difference. Multiply by tax rate. Let's see what is the tax rate. Tax rate is 30%. Deductible temporary difference into tax rate gives you the deferred tax asset. So there's a deferred tax asset of 14.7 million. Now try to understand. In 2014, we have opening deferred tax asset 14.7 million. Repeat. In 2014, we have opening deferred tax asset 14.7 million. Okay. Now, what are they saying? OL sells goods with a 1-year warranty and warranty expense is 2% of the sale. Sales amount is 1750. So in the current year, the sale amount is 1750. Multiply by 2%. Now, please, 1750 multiply by 2%. I'm getting 35. So 1750 multiplied by 2%. I'm getting a warranty provision of 35. Okay. How much of the warranty provision is paid? Please look at this. Total payment is 54, but out of this 54, 38 pertains to the previous year. Now try to understand. Out of 54, 38 pertains to the previous year. So how much belongs to the current year? 54 minus 38, it is 16. So 16 belongs to the current year. Current year total provision is 35. Out of 35, 16 we have paid. So the closing provision is 19. Repeat. Current year sale multiplied by 2% gives you the warranty provision of 35. But out of this 35, we have paid 16. So logically, the closing warranty provision is 19. So in 2014, carrying amount, tax base, and temporary difference. Warranty provision is 19. Taxation authorities do not accept provision as a liability. So tax base is 0. They do not accept any provision. Provision will always result in deductible temporary difference multiplied by 30%. This is going to be your closing deferred tax asset. Closing deferred tax asset. 19 multiplied by 30. I'm getting 5.7. Less opening deferred tax asset. Opening deferred tax asset is 14.7. So listen carefully. There's a reduction in deferred tax asset. Reduction in deferred tax asset is treated as deferred tax expense. So basically, we have a 9 million deferred tax expense. 9 million deferred tax expense. I would say it's a really, really good question. Question number 19. That please at least try to watch this lecture 2 times for this question number 19. Okay. I'm just giving you a little homework regarding this question number 20. Relates to the same question. What is the amount of the current tax? Let me just give you the idea. All you need is just convert the accounting profit to the taxable profit. How do we convert accounting profit to the taxable profit? Number one, taxation people do not accept your warranty provision as your liability, as your expense. So you have to add back the warranty. They do accept payment as an expense, so I will deduct the payment. But you have to look after for the reversal of provision as well. Logically, the reversal of provision is treated as an income by the accounting people. But taxation people do not accept a reversal of provision as your income. So I've just given you the few tips. By keeping these tips in your mind, try to attempt this question. And otherwise, in our regular class, obviously, we will discuss this question number 20 as well. No doubt about it. And those students that are in our regular classes, today's regular class will start, I think, after 45 minutes. So that was all about IAS 12 test. One question is left, which we are going to discuss in our class after just 45 minutes in a regular class. And right now, in a previous regular class, we did discuss the conceptual framework. And we will be discussing, there will be more discussion on the framework today. And just one announcement for those that are watching right now, and those they might be watching this on YouTube, that within next 2 to 3 weeks, we will start a live batch for December session, the live batch for PM, performance management. So you can join and you can inform others to join our live batch for PM. So thank you very much. See you all in the next class. Have a nice life. For regular students, please, we will start the regular class after 45 minutes.